Hello and welcome! In this video, we will discover how Warren Buffett made close to $100 billion. Most investors are familiar with Warren Buffett, who is the man in command at Berkshire Hathaway, or BRK.A, BRK.B. Buffett is one of the most successful investors of all time, with a net worth placing him somewhere in the top 3 richest people in the world. His partner in crime was Charlie Munger, who has worked with him for the past 50 years. While most investors are familiar with the story of Berkshire Hathaway, few seem to know how exactly Buffett made his first millions that catapulted him to Berkshire Hathaway and the companies and stocks he owns through it. Let's find out his complete journey, but just before, make sure you subscribe to the channel. And don't forget to download your free book on financial freedom by clicking on the link in the description below. When I talk about investing in the stock market versus investing in real estate, I often hear that the stock market is a better investment because of what Warren Buffett has done. Warren Buffett has made billions of dollars in his career, but was it because he invested in stocks? I think Warren Buffett has made billions from the stock market, but not in the traditional way most people invest. Warren Buffett is a very smart man and utilized not only his money, but other people's money as well. He was also a very active investor. He did not sink his money in an index fund and wait for it to slowly go up. In fact, his company often bought entire companies, not just stocks. So while the stock market has been a great investment for Buffett, I don't think saying he got rich from investing in stocks is an entirely accurate statement. Buffett started several investment partnerships in 1956 with approximately $105,000 in investor money after his former employee, Graham Newton Investment Partnership, was liquidated. Buffett had put an initial $700 of his own money, which ballooned to a stake worth $20 million by the time he liquidated his investment partnership in 1969. The assets under management had grown to $100 million by that time. The Berkshire Hathaway annual letters to investors have been inspired by Buffett's annual and semi-annual letters to his limited partners. Per the Buffett Partners Agreement, Buffett, as the general partner, received a cut of the profits. For every percentage point gain above 6% in a given year, Buffett collected 25% of the gains. The Buffett Partnership Limited, BPL, was essentially a hedge fund which pooled investors' money and invested them at the discretion of the fund manager. Buffett never had a losing year during the 13 years he ran the partnership, and he also managed to add new investors along the way. In addition, he reinvested any gains he made as a general partner back into the partnership. Buffett invested in the following types of companies at the partnership: generally undervalued securities, workouts, and control situations. Workouts included stocks whose financial results depend on corporate actions rather than supply and demand factors created by buyers and sellers. Control situations include occasions where BPL either controlled the company or took a sufficiently large position that allowed it to influence policies of the company. After the BPL was liquidated, Buffett received shares in Berkshire Hathaway, as well as shares in companies which ultimately merged in Berkshire. And the rest is history. The lesson to be learned from this exercise is that in order to become rich, Warren Buffett had a scalable business model with a substantial amount of leverage. Unfortunately, BPL was mostly a one-man operation. Although the turnaround expert he employed with Dempster Mill Manufacturing Company is a rare situation where he employed others. He did exchange ideas with several of his value investing friends, however. Buffett's investment model worked well when he had $100,000 in the partnership, as well as during the time that he had $100 million. The overvalued market in the late 1960s, however, presented a change to his investment strategy. Buffett had leverage to make a lot of money simply by being the general partner and earning a good cut on any earnings that the partnership generated without much downside for himself. On the other hand, Charlie Munger made his initial million by using debt leverage to invest and build real estate. Buffett created his cash-gushing conglomerate out of an ailing textile firm that he took over more than 50 years ago. Berkshire Hathaway now has dozens of subsidiaries, from railroads to utilities to candy companies. It has 367,000 employees, $24 billion in annual profit, and market capitalization approaching $500 billion. While Buffett's big acquisitions have made headlines, wise investments in companies like Coca-Cola, The Washington Post, and Gillette have provided the capital to make those acquisitions possible. Since taking control of Berkshire in 1964, the company has acquired 68 subsidiaries. In March of 1964, Berkshire acquired its first insurance company, National Indemnity. Recently, he bought 80% of the Israeli Metalworks Company, and he did it without even seeing it. He was approached by the promoter via a letter, and what was in that letter convinced him that, quote, "this was the kind of business I wanted to do business with, and it is the kind of business we wanted to own," end quote. How does this daring bit of investment fit in with his usual careful way of investing? He explains, "I had to size up the business, but that's a background of being in stocks. If you put your whole net worth in stocks when you are 20 to 21 years old, you have not visited the businesses, but you are really analyzing their financials, you are trying to assess whether they have durable competitive advantage, assess the quality of the management and the integrity of the management, and then you try to figure out whether you are buying it at a reasonable price. And that's it. That is all we do." The true genius of Buffett is his complete transformation in the 1970s, when he started purchasing stock in companies with strong competitive advantages. He essentially held those stocks as long-term investments, and in the event where Berkshire acquired entire businesses, he delegated the whole oversight of day-to-day operations to skilled management. The companies he invested in the 1950s and 1960s represented mostly investments that were one-time producers of substantial gains for BPL. It took Buffett a lot of time to uncover those opportunities, but once they reached full valuation and he sold them, they were no longer producing any benefit for his partnership. He then had to spend more time to find more investments to allocate the now higher cash hoard. However, the companies and securities that Buffett purchased since the 1970s for Berkshire Hathaway generate recurring cash flow streams to the company. As a result, the effort required to uncover these hidden gems resulted in cash distributions paid to the main holding company for decades. He then used these cash streams to purchase even more cash flow generating assets, which is why I believe that he is a closet dividend investor. Also, Warren has been able to uncover undervalued assets over many different asset classes. Examples include his purchase of silver, SLV, in 1998, real estate investment trusts in 1999, foreign exchange currencies, such as the euro in the early 2000s, as well as selling long-dated puts on major market indexes. Warren Buffett's most impactful investment was in the insurance company Geico. He started buying stock in it in 1951 when he learned that Benjamin Graham was on the board of directors. Graham is the author of The Intelligent Investor, which Buffett has called the world's best book on investing. Eventually, he sold his stock at a profit. Then he started buying again many years later and eventually gained majority control of the company in the late 1970s when the business was struggling. Buffett ended up buying Geico in its entirety through Berkshire Hathaway. Today, Geico is probably worth over $50 billion. His tens of millions of dollars invested early on have increased by at least several hundredfold, and the operating profits from Geico have been used to invest in other businesses. Buffett has also cleverly made use of the float from Geico and the other insurance companies that Berkshire owns. Float is money from insurance premiums that may be used to pay claims later. Berkshire now has over $100 billion in float that Buffett uses to invest and get compounding returns. Overall, the investment in Geico was probably the single most impactful investment for Warren Buffett, and a large part of the reason why Berkshire Hathaway became so enormously successful. The notion that Warren Buffett became Warren Buffett by buying and holding large chunks of blue-chip stocks is part of the story, but it does not adequately explain why he has been able to build a $50 billion fortune. It is the operational leverage through his insurance holdings and private businesses that has made him the richest man in the world. This is not to say that his blue-chip investments in Procter & Gamble, Coca-Cola, and so on have not played a role in making him rich. After all, Coca-Cola currently trades at $40 per share, and Berkshire Hathaway's cost per share is $3.25. Increasing wealth 12-fold in 25 fives is nothing to ignore. It's hard to construct an alternative hypothetical universe, but my guess is that if Warren Buffett had to only own blue-chip stocks his entire life, then his net worth would probably be between $50 million and $150 million today instead of $50 billion. Without leverage, Buffett would be some random rich guy that you'd never heard of. He'd be able to give his kids and grandchildren $13,000 stock gifts for Christmas, and he'd be able to spend his life in the top 0.001% of humanity that ever existed. He'd have complete control over his time, and he could own a couple homes and vacation whenever he desired. But if you want to know what made him really, really rich, then you have to look at the cash generators. A potential lesson from Warren Buffett's life is that it is important to own something outright that gives you money to invest. It's one thing to be saving $500 per month and putting it into blue-chip stocks. That's very nice and it builds wealth. But if your ambition is to use blue-chip stocks as part of a strategy to get really rich, then you need to have an asset under your belt that gives you lots of regular income to deploy. Imagine someone owning a $3 million apartment complex that spins off $300,000 in annual income. If you owned an asset like that, you'd have life made. You could enroll in the DRIP program of your 15 favorite stocks and have $1,000 invested into them every month. Wealth starts to get built very, very quickly when you have a primary cash-generating asset that gives you regular money to invest. Buffett did not amass his fortune by following the herd, but by leading it, Roberts wrote. He is sitting on $128 billion in cash for a reason. Buffett is fully aware of the gains he has foregone, yet still continues his ways. Buffett is not dumb. When you study Warren Buffett's life, the important lesson is to get your hands on an asset generator. It might be real estate, it might be energy MLPs, it might be the local car wash. Own it outright, and then taking the constant flow of funds to start buying blue-chip stocks. Charlie Munger talks about drowning in income. Well, that's the lesson from Buffett's life. You can work your ass off to own a cash generator, and instead of treating that money as a windfall to upgrade your lifestyle, you use it exclusively to purchase blue-chip stocks. That allows your life to become a perpetual wealth-building machine. If you reach a point where you have a system in place to invest thousands of dollars per month, you can't help but win and get wealthier with each passing year. In the game of life, you've won! Hey, if you enjoyed this video, please like, share, comment, and especially subscribe to the channel. You are also free to receive the new book, 5 steps to reach financial freedom by clicking on the link in the description below the video.